Okay, in the following few lessons, we're going to take a look at the different entry types that we have within the framework that we've presented to you guys so far. All right, so the one that you see right now on the screen is the risk entry type, right, which is one of three different types of entry types. Okay, so first of all, with the risk entry, what do we do first? We identify a point of interest on the higher time frame, which would be your level of supply in this case, since we are looking at downward momentum here. And then we go and refine this higher time frame order block to a lower time frame order block if it is necessary, right? So we know that ideally we would want some price inefficiency before the creation of the order block, right? Which would strengthen ultimately the strength of that area of supply or demand in the case of an upward movement. Okay, and when you go and refine on the lower time frames, you also want to see that inefficiency on that lower time frame, right? To give reason for price to come at least to the lower time frame and then move lower. Okay, and ultimately you would be setting a limit order, in this case a sell limit on the refined order block for your entry, and of course your stop loss at the top of the higher time frame order block, right, with a little buffer of about 2 pips in this case, right? So we see the entry at the refined lower time frame order block, stop loss above, and TP wherever makes most sense, right? Usually at the previous lows. And of course, the way you manage your trade and your risk is up to you and how you approach the market. However, once price kind of starts breaking these lows, right, we could expect price to kind of pull back and then break this low and then this low, and then of course you could start mitigating your risk in this case, right? However, ultimately you'd want price to come back towards this low and then even create an extension further down, right? Now for risk entries, they are best used when the point of interest and trade idea is pro trend. And what I mean by pro trend, I just mean that you're taking a trade with the direction of the market, the direction of the structure. In this case, you can clearly see a high, lower low, lower high, lower low, and we're seeing here a potential lower high for continuation to create a lower low, right? So this is what I mean by pro trend. It strengthens the probability of you being in a successful trade, right? Now it is also best used when the lower time frame order block is within the higher time frame point of interest, right? So as you can see here, we have the higher time frame order block, and within this order block we have a lower time frame order block. And of course this means you'd want to see some price inefficiency within the order block for the creation of this lower time frame block. And it is also best used to approach a trade aggressively, right? So if your personality, right, as a trader or just as a person in general, you're more aggressive in the thing you approach and the way you approach your trading, right? A risk entry is named risk entry for a reason. You're entering on minimal confirmation, right? So it is best used to approach a trade aggressively. It's also best used as a set and forget approach to trading, right? So if you don't have much time or your lifestyle doesn't provide you enough chart time or anything like that, right? This could suit your lifestyle much better than the other entry types that we're going to be visiting shortly after this one, right? And it's of course best used when the price comes back to the point of interest in a corrective manner, right? So we know that these big impulses here, right, which create price inefficiency, are induced by large bodied candles, right? Now it will strengthen the probability of this higher time frame or lower time frame order block, or just this point of interest in general, if price is coming back to it in a corrective manner, right? Because this just shows that momentum is to the downside. This is a corrective move for price to create the next impulse to the downside. Okay, so there's pros and cons of a risk entry type, right? So number one, for the pros, we have that it provides entries to trade that tap into the point of interest and run. So a lot of times, right, you'll see price tapping in here and really moving significantly and very quickly, not allowing you to take advantage of the other entry types that we're going to be visiting shortly after. Okay. It also provides a high risk to reward as the point of interest is refined to the lower time frame. So rather than entering on the higher time frame order block down here with a stop loss above, right, we're refining on the lower time frames, taking in some of the technical analysis tools and the behavior of price and where price tends to gravitate to, right? So if we understand that there's still price inefficiency in here within this higher time frame order block, there's reason for price to tap into this lower time frame refined order block, right, allowing you to have a smaller stop loss and ultimately increase your risk to reward on your trade. And of course, maybe the number one reason why people use risk entries is because it's autonomous. It gives you autonomous execution, so it requires a lot less chart time, right? However, the cons of this entry type is that it is minimal confirmation for entry, so the likelihood of being tagged in and out of a trade is increased. So sometimes, if you ignore certain type of information like session timing or economical news events, or just, maybe this is a low probability, right? Low probability order block for XYZ reason. There might be one that's higher that makes most sense to use rather than this one, right? You could potentially just get tagged in the trade and shortly after price moving up, hitting your stop loss. Okay, so now let's take a look at other illustrations, right? Different variations of a risk entry. Because we're entering in a low confirmation environment, right? We would like to see things like liquidity pools being created, right? So this is just another variation in which price is still moving in a corrective manner back to this higher time frame order block. However, you can see that this strengthens the probability of this order block playing out, since we know we have a set of equal highs, and we can see price running the liquidity above these highs, tapping into this price inefficiency and area of high volume for price to push higher, to push lower, right? So we know that price seeks liquidity at all times, right? Hence why having an area of liquidity just below the order block strengthens, the order block working in a risk entry type of environment. Okay, and of course everything I spoke about just before that, the benefits and the disadvantages of using the risk entry, you'll see it within this this illustration. You can pause it, take note, but you'll also have access to it in the ebook or PDF, right? So let's move forward with a live example on the chart to show you what a risk entry would look like with on a candlestick chart. Now let's take a look at this candlestick chart example of a risk entry on Euro USD on the 1 hour time frame. Now we can see here we have a 1 hour order block, right? We have price inefficiency that was created on the impulse to the upside, which first broke this point of structure here, right? But ultimately the previous highs, creating this impulsive leg, and then you see price coming back down in a corrective manner, right? The size of these bodied candles, or just these candles in general, are a lot smaller than the ones that you see within this impulse here, and you can see a sequence of lower highs and lower lows to reach that order block, right? Now, one thing that strengthens this order block is the fact that we have price inefficiency, right, imbalance over here. And the reason why we're not worried about our stop loss being below here is because we know that within this impulse here, right, which would have impulse from, this area of demand, right, price coming back to this area, right, this is a mitigation of this whole area for price to push higher. And we can see that by looking left, right, anywhere below this area here, price delivery is quite efficient, right? So for price to continue to the upside, it's highly likely, right? Not only that, we're clearly trading with the trend, right? So this is a pro trend trade, right? So all these things tick the boxes for a risk entry type, right? Now let's just use the bar replay here, and I'm gonna zoom in to the 15-minute to see if we can actually enter on the a refined 15-minute order block to see if there is reason for price to push lower. And we can kind of see price did push around the 50% mark of this order block, okay, giving you a better entry opportunity. However, let's go see on the 15 minutes. And by looking at this here, we have right over here, right, this would be our point of interest on the 15 minutes. Why? Because just before this candle, we then had true momentum kicking in, breaking above these highs, and then of course the higher time frame highs. And you can see that there's a big area of inefficiency here for price to come back and fill, right? So we just went from a risk entry on the 1 hour order block to refining it to the 15-minute order block, right over here. Or we can go based on the true 15-minute order block, right? This last 15-minute bearish candle. Okay, and we can factor in the lows. And of course, your entry would then go a bit lower. Your stop loss would be smaller. So initially, we had a 30 pip stop loss for a 150 pip reward for a 5-to-1 risk to reward. However, just this little refinement, right, giving you, this is 13.5, let's say 16 pip stop loss. So nearly half of the stop loss for an ultimate, you know, plus 10 times or a plus 10 risk to reward trade setup. So this is a prime example of a risk entry, and it ticks a lot of the boxes for us to use this type of entry method. Now let's take a look at another example here on AUD USD. In a bearish scenario, we can clearly see momentum or structure is clearly bearish, right? So the risk entry could be used as we are in a pro trend analysis, right? We can see that price, after pushing extremely low, right, we have a corrective move up and then a new impulse to the downside, breaking this structure, the previous structure here. And what you essentially see here is a trend line liquidity or a sequence of mitigated order blocks where we would have generated cause and reason for price to push lower, right? Now, what would be the point of interest for us to target to the downside? Of course, we would have the previous lows and then, you know, looking to create a lower low, right? If we are pro trend, we're looking at impulses to the downside, corrective moves to the upside, and another impulse, breaking the previous lows. Okay. Now let's take a look at this here. We can clearly see that within this impulse here to the downside, the price paused in the market, right, to create more order flow. So this is clearly the point of origin, right, of this move to the downside. However, notice how there is very little or very low price inefficiency in here. However, within this impulse here, we created this big imbalance, right? Cause and reason for price to come back to mitigate and tap into this area of high volume to then push lower, right? Not only that, we had created a set of equal highs with this high over here and this one as well. And then the move to the upside, right, back to this higher time frame point of interest was moving back up in a corrective manner, right? Now, if we enter on the basis of, you know, the framework of the order block, right, our entry would be at the proximal point, stop loss slightly above, giving us a 15 pip stop loss and an ultimate 90 pip reward for a 6 risk to reward setup. And let's go and see how we could go and refine this order block, right? So we know that the point of interest, right, on the 1 hour where the inefficiency would, you know, get filled completely is at 0.76296 price point, right? We go down to the 15 minutes. Okay, we can clearly see that that price point is exactly where we have a 15-minute order block, right? Where we can refine the higher time frame order block with a 15-minute order block within the higher time frame point of interest, right? We can clearly see that below the low we have a little bit of price inefficiency, as you can see right here, right? And this one down there. For us to refine our entry, of course, we would have our stop loss. This would be a 9 pip stop loss, all right, or a 9.3 pip stop loss. So we can add a buffer of about 2 pips. Okay, so let's say 9.5, say 11 pips. Okay, which our trade would have been safe, right? It wouldn't have been a loss and price moving back down to the downside, giving us ultimately an 8.18 risk to reward, which is, you know, about 2 times, an additional 2% on a 1% risk trade, right? However, if for any reason, right, and this is something that I might consider or do, right, I'm refining my entry, however, I can keep my stop loss above the actual higher time frame order block, since there's only a few pips difference, and I'd rather be safe than sorry. So if this is a 13 pip stop loss, we would have a 15 pip stop loss, right, giving us a, so previously, sorry, this would have been an 8.18 times risk to reward. However, the entry would have been a slightly higher, right, with stop loss at around here, so giving us about more than 10 times our risk, right, in reward. However, like I said just before, instead of having a 15 pip stop loss, I would simply refine my entry to the to this 15-minute order block with stop loss at the high or the distal point of the higher time frame block, which was 10 pips, and we would have a 12 pip stop loss for the same point of interest for reward, right, giving us an additional, we can go a little lower since we moved up our entry by about 3 pips, right, nearly 8 times the risk to reward.